PantheonAI presents Emerging Market Surge. USD faces downgrade pressure. Fintech M&A picks up. Welcome back to the PAI Morning Briefing.
And I'm your host from PantheonAI. It is May 19th, 2025. Good morning, everyone.
Good morning. Hope you're all settled in, coffee or tea in hand, ready to dive into today's market action and news. We've got quite a bit to unpack.
Yeah, it's been a busy one already. Let's kick things off with a quick market overview just to set the stage, shall we?
Absolutely. How are the major U.S. indexes looking?
Well, the S&P 500 closed at roughly 5,938. That's actually up by about 0.6%, showing a pretty steady upward momentum.
Okay, modest but positive. What about the Dow?
The Dow Jones Industrial Average is sitting at approximately 42,562. It had an almost negligible change, just around 0.045%.
Right, the Dow can be a bit slower, often more of a long-term stability indicator.
Exactly. Now our tech-driven Nasdaq, that's been a little more lively. It's near 19,108, showing an increase of roughly 0.9%.
Not surprising, tech's been on a roll. And the small caps, the Russell 2000?
The Russell 2000, which caters to that small cap universe, is trading at around 2,092, up by approximately 0.5%.
So traditional markets showing some modest gains across the board, but what about digital currencies?
That's a bit of a different story right now. Bitcoin and Ethereum have been kind of a mixed bag recently.
Oh?
Yeah, Bitcoin's around $104,610. But it's actually down nearly 1.8%. Kind of reflects a bit of bearish sentiment creeping into the crypto space at the moment.
Interesting. And Ethereum?
Ethereum, trading roughly at $2,558, isn't too far off in terms of performance, showing a decline of approximately 1.7%.
So while traditional markets are seeing gains, crypto's pulling back slightly. Just a reminder that, investors really need to keep an eye on risk and reward in that volatile environment.
Absolutely. Now let's move into a bit of a deeper dive into some of the major market trends shaping things today.
Okay, what's catching your eye?
Well, one of the key stories making headlines is this renewed buzz around emerging market stocks.
Emerging markets? They've been underperforming for a while, haven't they?
They have, for some time. But that narrative seems to be slowly shifting. According to strategists over at JPMorgan, emerging market stocks have already returned double digits this year. They're really starting to see them in a new light.
Wow, double digits. That bullish stance is pretty intriguing. It signals optimism, obviously, but it also highlights the importance of diversifying portfolios beyond just the traditional powerhouses.
Right? And JPMorgan's analysts believe it's down to improved fundamentals. Things like political reforms in these economies, increased consumer spending, and a real emphasis on technological upgrades. It feels like that groundwork has really been laid for this turnaround.
It's like watching a long slumbering bear finally wake up. The market dynamics are definitely shifting, and there's a sense of cautious optimism.
Cautious is key, though, isn't it? Because, as always with emerging markets, there's that element of risk. Geopolitical instability or unforeseen economic shocks could still potentially derail these gains. Investors need to stay agile and well-informed.
Good point. Switching gears a bit, let's talk currency markets, specifically the USD against the Swiss franc.
USDCHF. That pair is currently under some pressure, and it's linked to Moody's downgrading U.S. sovereign credit.
Yes. That downgrade caused a ripple effect, leading the dollar to face broad-based pressure.
Exactly. And technical analysis shows that the recent rally in the USDCHF failed to hold above the 100-hour moving average. That's often seen as a pretty strong barrier or support level by many traders.
Right, so in layman's terms, it's like the dollar tried to run up a hill, but the slope was just steeper than expected.
Pretty much. For anyone invested in forex, this is a timely reminder of the volatility inherent in currency markets and just how important it is to watch those key technical indicators.
Definitely. Speaking of volatility and shifts, let's look at some corporate moves and acquisitions, stirring things up. Paramount Group, for example.
Oh yes. Paramount Group recently announced they're starting a strategic review following the unexpected resignation of their CFO.
Wow. A key executive exit like that, especially the CFO, often sends ripples through a company's valuation and strategy.
It really does. Investors are watching closely to see if this signals a larger restructuring or an attempt to reposition the company in this rapidly evolving market.
Yeah, definitely one to keep an eye on. In related news, Gladstone Investment made headlines with its acquisition of Smart Chemical Solutions.
Right, and that deal really underscores the ongoing trend of consolidation we're seeing in the industrial and chemical sectors. Companies are looking to leverage complementary technologies and operational synergies to boost long-term growth.
So the strategic play here is clear. Acquire companies with differentiated tech and expertise to capitalize on new market opportunities.
Exactly. Now, perhaps one of the most thought-provoking pieces of business news comes from biotech and consumer genomics. 23andMe.
Oh, what did they do?
In a surprise move, they've sold their most valuable asset.
Seriously? To whom?
To Regeneron. Following the acquisition, Regeneron has reassured investors that they'll continue to provide uninterrupted service for the genome services that allow users to connect with living relatives through shared DNA profiles.
Okay, so the core service seems safe for now. But selling their most valuable asset, that brings up questions. Is this a strategy to double down on biotech research, or a shift towards more traditional pharmaceutical endeavors?
Right? Either way, it highlights just how fast evolving the biotech industry is. Partnerships, acquisitions, asset sales, it's all part of the game, and it keeps the industry incredibly vibrant and, frankly, unpredictable.
No kidding. Any other notable transactions?
Yeah, Ares Management acquired a majority stake in Landscape Workshop. That move can be seen as a bet on the future of real estate management and infrastructure investment.
That makes sense in today's economy, doesn't it? Where sustainable development and environmentally conscious investments are really on everyone's radar. Owning a significant share in a company specializing in landscape and infrastructure management seems like a savvy move for Ares.
Definitely. Manufacturing and aerospace also got a shakeup. TransDigm Group and Servotronics have come together through an acquisition agreement.
Okay, more consolidation there.
Exactly. And if that wasn't enough, Dogness announced its plan to acquire a 19.5% equity interest in Dogness Intelligent Technology.
Dogness acquiring a stake in Dogness Intelligent Technology. That's interesting. It suggests they're really looking to bolster their portfolios through acquisitions, particularly in sectors where technology and automation are evolving rapidly.
It's almost like a game of corporate chess, isn't it? Every move carefully calculated to capture more market share and technological prowess.
That's a good way to put it. Now let's talk a bit more about some of the implications behind all these moves. It feels like we're seeing more than just isolated deals.
Totally. What we're witnessing is a broader, almost symphonic trend that cuts across sectors and regions. That bullish stance on emerging markets, for instance, is really compelling investors to redefine their portfolios.
The narrative of stagnant growth in emerging markets seems to be genuinely shifting towards optimism about innovation and improved governance.
And then you have the currency fluctuations, where even the traditional safe haven, the US dollar, is feeling pressure from global forces and technical trading levels.
These stories really remind us that, in today's interconnected world, no market truly lives in isolation.
Right. Let's dive into a detailed sector analysis based on what we've discussed.
Okay, tech first?
Sure. In the tech space, trends seem to be oscillating between exuberance and caution. As we noted, tech-heavy indexes like the Nasdaq have performed well, hitting near that 19,000 mark. That reflects investors' continued appetite for technology-driven growth.
Meanwhile, the challenges faced by the US dollar, partly from the Moody's downgrade, provide a contrast, highlighting a crisis of confidence in even the most established financial instruments.
Exactly. It's an interesting juxtaposition, underscoring the digital transformation of finance against the backdrop of traditional economic metrics.
And peeling back the layers on emerging markets, it's a fascinating dynamic. When you combine geopolitical developments, technological adoption, and rising consumer demand, you really start to understand why JPMorgan's bullish outlook is gaining traction.
There's a lesson there, isn't there? Sometimes the best investments are off the beaten path, in places where growth might seem uneven on the surface but holds tremendous potential underneath.
It's worth pondering. Could these emerging markets be like a rough diamond, just in a pre-polish phase before a major surge? Investors are clearly starting to reallocate capital and diversify into these regions.
Definitely. Now, energy is another critical sector, though not directly in our headlines today.
True, But global energy markets are always facing their own set of challenges, from fluctuating oil prices to debates about renewable energy.
Right, with environmental concerns and regulatory pressures increasing, energy companies have to balance current profitability with long-term sustainability. Could we be on the brink of a major shift where traditional oil and gas companies have to adapt quickly?
Only time will tell, but it's a question shaping investment in that space. And in finance, the headlines really speak volumes, don't they?
They do. The pressure on the US dollar, the subtle shifts in market sentiment, corporate actions like Paramount's review, it all serves as a barometer for global economic confidence.
And these events have far-reaching impacts. If the dollar weakens, investors might seek shelter in diversified assets or even digital currencies, despite their current downturn.
Exactly. How this balancing act evolves in the coming days and months is key. Investors need to ask themselves if their portfolios are agile enough to navigate potential headwinds.
Before we wrap up, let's take a moment to look at the broader picture and global implications.
Beyond the U.S., emerging markets seem poised to play a significant role in shaping future investment flows. When institutions like JPMorgan point to growth there, it's not just local. It's a global trend that could influence everything from commodity prices to bond yields.
And moves like Moody's Downgrade underscore a fundamental truth. Global finance is a delicate dance. Each misstep or unexpected pivot, whether it's corporate leadership changes, acquisitions, or currency shifts, can send shockwaves beyond regional boundaries.
International investors are watching closely. As more money flows into emerging markets, traditional safe havens might lose some allure. Conversely, these markets could see volatility as they absorb increased capital.
So how might the rise of emerging markets reshape not just local economies, but the truly global investment landscape?
That's the big question. In terms of expert insights, while there's growing optimism, caution remains the watchword. Many analysts, including those at PantheonAI, believe prudent portfolio diversification is still the best strategy in uncertain times.
There are opportunities everywhere, whether it's tech, emerging markets, or strategic acquisitions, but every investment comes with risks.
It's almost worth chuckling at how unpredictable the market can be. I like to say they're like my neighbor's cat. Unpredictable, mysterious, and sometimes a little bit hysterical.
Ha! But unlike cats, we can study trends and analyze data to hopefully make educated moves.
Exactly. The secret is staying informed and constantly questioning what you thought you knew. Let's quickly recap some of the key headlines.
Okay, first up, emerging markets turning a new leaf with double-digit returns, prompting institutions like JPMorgan to turn bullish.
Right. Second, the USDCHF is under significant pressure following the U.S. sovereign credit downgrade by Moody's. That technical breakdown suggests caution for dollar exposure.
Third, Paramount Group starting a strategic review after their CFO resigned. Corporate restructuring moments can signal both potential renewal and risks.
Fourth, Gladstone Investment's acquisition of Smart Chemical Solutions, highlighting the ongoing consolidation in the industrial sector.
Fifth, the unexpected pivot by 23andMe, selling its most valuable asset to Regeneron. A fascinating example of how biotech companies must continuously evolve.
Sixth, Ares Management acquiring a majority stake in Landscape Workshop, potentially signaling new investments in real estate and infrastructure management.
Seventh, TransDigm Group and Servotronics cementing an acquisition agreement, showing that intersection of manufacturing and advanced technology.
And eighth, Dogness planning to acquire a 19.5% equity interest in Dogness Intelligent Technology, doubling down on in-house expertise.
Each of these stories carries nuances reflecting broader trends. While seemingly isolated, together they form a complex mosaic of market sentiment and strategic recalibration.
Moving back to sectors, tech continues to dominate headlines. Despite dips in crypto, sentiment for tech overall remains upbeat, evidenced by the Nasdaq's performance.
But remember, with tech, the rate of change is exponential. What works today might need a radical update tomorrow.
Absolutely. The financial sector, in contrast, is in flux. Traditional institutions grappling with the Moody's downgrade and executive changes. These disruptions aren't necessarily negative. They can be precursors to innovation.
It's like rearranging deck chairs, but on a ship with state-of-the-art navigation that might just steer it back to calmer waters.
Exactly. Energy, though less headline-grabbing, is equally important. Companies are adapting to a world where renewables are increasingly viable. While not directly in our news today, the themes of transformation resonate across all sectors.
Investors should be mindful of how shifts in energy policy and consumer patterns might indirectly influence other areas like manufacturing, transportation, and even tech.
Globally, these market forces have far-reaching implications. Developments in the U.S. often set the tone for global capital deployment. As emerging markets deliver strong returns, investors worldwide are likely to reassess portfolios.
Currency pressures like on the USDCHF could also trigger a wider discussion about the reliability of traditional safe havens, prompting central banks to rebalance reserves.
The ripple effects could be felt in bond markets, commodity prices, and even multinational corporate strategy. Expert insights point to caution despite opportunities.
Diversification isn't just a buzzword. It's the cornerstone of a resilient strategy in times like these. Are you ready for a market that's as unpredictable as it is opportunity-laden?
And how frequently do you reassess your portfolio in light of new global trends? Let's quickly summarize the key takeaways.
First, while traditional U.S. indexes offer steady gains, emerging markets are brimming with potential, albeit with complexities. This trend, bolstered by institutions like JPMorgan, is a fascinating opportunity.
Second, the pressure on the U.S. dollar, seen in USDCHF post-Moody's downgrade, reminds us that technicals and fundamentals are in constant dialogue. Never be complacent.
Third, corporate maneuvers across sectors, from strategic reviews to acquisitions, point to a dynamic landscape where companies are continuously recalibrating. These could have lasting impacts.
And finally, our global outlook hints at a convergence of traditional and emerging paradigms. The future isn't about picking one winner. It's about a balanced portfolio that can weather storms and ride waves of innovation.
How do you see the balance shifting between emerging market opportunities and traditional safe havens in the coming months?
And what steps are you taking to ensure your portfolio remains as dynamic and adaptable as the markets themselves? As always, your thoughts and questions are welcome.
Feel free to reach out to our AI copilot anytime, because your insights are just as valuable as the market data we analyze.
It's been an engaging discussion today, covering everything from indexes and crypto to corporate moves and global dynamics. Every market shift and announcement carries lessons.
Whether you're a seasoned trader or just starting out, always keep learning and questioning.
Thank you for joining us on today's briefing. Don't forget to tune in tomorrow for another in-depth analysis.
And as always, remember, learning shouldn't feel like a full-time job. Shout out to PantheonAI, your information co-pilot, guiding you through market complexities with insight, analysis, and just the right amount of humor.
Until next time, keep questioning, stay informed, and invest wisely. Have a great day, everyone. PantheonAI, your information co-pilot.
Because learning shouldn't feel like a full-time job. Take care and see you next time.